afternoon. My name is Shari, and along with David Rappaport, we welcome you to our virtual town hall with Shari and David answering your questions. Before I begin, I just want to make something clear because we did receive some comments. When we initially sent out the invitation for this webinar, it was in a newsletter coupled with the blog I had wrote about the perfect cocktail. So some people asked me, are we going to be talking about cocktails as well as investment strategy today? And we are not going to do that, but I am always happy to talk to anyone afterwards about cocktails, including my husband, loves to talk about it too. And we will send you the blog with the recipe as well after the webinar. So thank you again for joining us. I'd like to begin. Most of you on this webinar know a little bit about our firm, but I'd like to start just to tell you a little bit about our firm. Next page, Dave. Great. Our firm was founded in 2005. We have 10 employees. We now manage over $625 million. And our firm was founded with one purpose. That was to maximize your return on life. Yes, we maximize the return on your investments, but we really want to maximize your return on life. We've been doing this for clients for years, and we call it our Maximize Your Return on Life solution. We begin by getting our clients organized and clarifying their financial situation. We then incorporate their values, and if anyone who on this call knows me, again, cocktails, I love to talk about, but values even more. We incorporate all of our clients' financial information and their values and do a 30+ page financial plan answering the most important questions for our clients. When can I retire, and can I continue to live my lifestyle in retirement? We implement these financial plans through low-cost, diversified, passive strategies or market-like strategies. We call it value-added indexing, and we don't stop there because we know our clients' lives change. We continually monitor and update the plan. So that's a little bit about us. We did receive quite a few questions from some participants before the webinar, and we've got a lot of questions that we have received over the last few months. So today, this afternoon, David and I are going to talk about things like the investment outlook with the Biden administration, why own bonds, where do you expect returns going forward? Is there things I should do before year end? But if there's questions that come to your mind, there's a Q&A box. Feel free to fill that in, put it in the Q&A or the chat, and we're going to be here. We're going to probably speak about 20-25 minutes, and then we'll have time to answer your questions. So now, Dave, and make them hard. We'd love to stump Dave because he loves to answer questions. So let's get some real good hard questions. So I'm going to begin, Dave, and the first question is, what do you think the outlook is with the Biden administration?
Shari, thanks
Dave,
a lot.
I think we can get rid of the questions if you want.
Thanks a lot.
My other job is I keep Dave on track here. So, and when he talks too much, I'll reel him in. But Dave, why don't you begin about the investment outlook with the Biden administration?
Absolutely, and thanks a lot for trying to stump me. We'll see if we can get through that. And you know, Shari, we've now had our business for about 15 years, so we've actually seen lots of presidents. So do you mind if I actually just go through a little bit of presidential history since we've been financial advisors?
Sure. I know you love to talk about that. So
I'll try to be quick. I started out in this business in 1990, so I've seen a lot of these elections. In 1990, it was George H.W. Bush, or Bush 41. And a couple of years later, we had a big election, and 1992, Bill Clinton was elected president. And I remember investors were really nervous back then. You know, the thing was that Bill Clinton was such a liberal, he was going to be terrible for the markets. And actually, investors did pretty well during the Clinton years. And
Dave, did you say Clinton was a liberal?
I did. I think we'd look back today and he probably was more moderate. But at the time, that was kind of the consensus. So Clinton was followed by George W. Bush, or Bush 43. And here's a guy who had a lot of bad luck. He inherited the dot-com bubble. So at the start of his term, he saw a big drop in stocks. And then at the end of his second term, was the beginning of the great financial crisis. So stocks did pretty lousy under W. But then we get Barack Obama. And again, had a lot of very nervous investors, and we heard it from some of our clients, and they thought that here's a guy who might be a socialist. And we kept getting asked, should we sell stocks? He's going to raise taxes, right? And he actually did raise taxes, but stocks did pretty well under Obama. And then so we come to Donald Trump, and a lot of, pessimism and fears about Trump, but the fears in terms of investing didn't last too long. Basically the night of the election, stock futures were down. The first hour was rough, but then stocks took off, and stocks did pretty well under Trump, over the term, and even, having recovered through the pandemic. So, here we are with Joe Biden, and, those that know our philosophy pretty well know we're not big on making short-term market predictions, but I think stocks can do pretty well under a Biden administration. He's got a lot of positives going in. He most likely will have a divided Congress, and investors like that a lot. They like gridlock. Even if the Democrats pick up 2 seats in Georgia, the likelihood of major tax legislation is still pretty low. We could see a continuation of the economy's recovery. Vaccines are just around the corner. That's good news. We could see action on a stimulus bill. The markets would like that a lot. Interest rates remain very low. So it's a pretty good climate, and stocks could do well under Biden. But I do want to share a little bit of history. And so I'm going to bring up a chart that kind of looks at presidential history it looks at stock market history rather by US presidential terms. And this goes back to 1929. And there have been 23 4-year terms, or almost, as this goes to the end of 2019. So that's a lot of 4-year presidential terms. And if you think about it, over the typical 4-year period, 4 years is a long time, stock market usually does pretty well, usually has a positive return. And it's no different here. You could see that 19 out of the 23 terms had positive returns. And that was both through, blue and red terms, Democrats and Republicans. So, the bottom line, don't try to get in and out of markets based on politics. And don't care if you kind of lean left or you lean right. You have to think long-term, way past the next 4 years or 8 years or anything else like that.
Yeah, and Dave, what's amazing on that chart, the average return, 10.3%. We're going to talk later about expected returns. So the next question we receive all the time is, bond yields are so low. Should I still be investing in bonds?
Yeah, very, very topical. We got to start out by acknowledging just the obvious. It is a rotten time to be a bond investor. And yields are just off of historic lows. Right now, if you go out and buy a 10-year treasury, you're going to get maybe 0.9%. I mean, it's kind of awful. And if you buy corporate bonds, let's say intermediate corporate bonds that mature in maybe 5 years, 6 years, something like that, you're looking at yields of maybe 1.5%. So the question, why should we own bonds at all in this very low yield environment, is not unreasonable. And we always start the conversation by saying, well, historically, there have been 2 reasons that you want to own bonds as part of a diversified portfolio. Historically, you got some good income, and the bonds were also a very good cushion for the inevitable downturns that come from owning stocks. And so unfortunately today, out of those 2 reasons, you only get one. You don't get much income, but you very much still get that cushioning effect. And that cushioning effect is, it comes from what we call low correlation. Bonds have low correlation with stocks, meaning they don't move in tandem. They each kind of march to their own drummer. So I want to share kind of a real life example of this. And I call this chart 12 months in the life of an investor. And it was an awful 12 months. This was March 1st, 2008 to February 28th, 2009. That was the worst 12 months of the great financial crisis. Really wasn't all that long ago. And we could start with looking at the bar on the bottom. Stocks were down 43%. That's the S&P 500. And we lived through it. It was painful. It was rough. But what if you own bonds? Do they provide cushion? And the answer is yes. We show at the top, US Treasury bonds did great as investors flocked to them for safety. They were up 8%. And in the middle, we have another category of bonds, and those are junk bonds or high yield bonds, bonds with low credit quality. And high yield bonds were down over 20%. They kind of acted like stocks. They didn't provide that diversification or cushioning effect. And so that's why we don't own junk bonds. So I think, that gives a sense of one of the reasons to own bonds in a portfolio. But, the other question that comes up is, okay, yields are real low. I get it. Why don't I just keep the money that I normally have in bonds and just keep it in cash? I mean, you can't get any safer than cash, and that's true, but you pay a price for that safety because cash is basically yielding zero, nothing. And don't be so sure that it won't be yielding zero for quite some time. The Federal Reserve, basically, their projections point to near zero interest rates through the end of 2022. That's 2 years from now. And the Fed chair, Jerome Powell, has basically said the Fed isn't even thinking about raising rates. So the consensus among bond market participants is you won't see rate hikes until late in 2022 or even into 2023. So you keep that money in cash and you get no return. You're paying a big price versus putting that money in bonds. And we think it's smart to stick with our strategy of conservative bonds, high quality, well diversified. We get it. They're not yielding that much, but we think over the next 3 years, 5 years from now, you will have a better return from those bonds than had you just kept that money in cash.
Yeah, great, Dave. And we sometimes hear, well, what if interest rates rise? I might lose on the bonds temporarily. And it could be temporary because the yield and the coupon will accumulate over time. But a drop in bonds might be 1 or 2%, where a drop in stocks, as Dave showed, could be 40 or 50. And we saw a big drop in 30 days this year. So speaking of big, Dave, can we talk about the tech stocks? Do you think they're going to continue to do as well as they've done?
Yeah, that's, again, Shari, these are questions I think we talk with our clients every day about. So you're looking at companies like Amazon and Google and Microsoft and Netflix and Apple. And, we all know these companies and we probably use their products quite a bit. I mean, I know that I do. And over the last several years, the stocks of these companies have been on fire because the companies have been growing like crazy. And that's why they're called growth stocks. They're growing their revenues at a much faster pace than the economy as a whole. And the price that you pay to own these stocks relative to your share of their earnings is very expensive, but nonetheless, they have dominated the market. And you're asking me, do we think that's going to continue? And so I'll start out with the good news. As many of you know, in our stock portfolios, we own them. We own these companies. They're among the largest holdings that we have. But having said that, we do give a little bit more weight to cheaper stocks, or what we call value stocks, than growth stocks that are held in a traditional index fund. So why do we give a little bit more weight to cheaper stocks? And it's historically, cheaper stocks have just done better than growth stocks. And that's they usually have done. And I'll kind of show you some numbers to prove that point. So here we have a chart that goes back to 1926. And we're looking at rolling periods, rolling 1 year periods, 5 year periods, 10-year periods. And going all that far back, if you look at over 1 year periods, cheap stocks or value stocks beat growth stocks about 59% of the time. So that's pretty good, but it's still kind of close to the flip of a coin. But then you go out over 5 year periods and it's almost 3 out of 4 of those periods, or 73%. And then you go over 10-year periods and it's over 8 out of 10. So that's pretty convincing. So why does that happen? Why over long periods of time do cheap stocks beat expensive stocks? It's really because you're buying cheap stocks as bargains. You're paying a lower price and you're getting more earnings, more cash flows. You're getting a better deal. But clearly that's not what's happened lately. It's been the opposite. And if we look over the last 5 years, um, we show this is actually 2 months short of a 5-year period. We divide the US market into two segments, two indexes, the Russell Growth Index and the Russell Value Index. And as you can see, over the last 5 years, growth stocks led by these big tech companies have just kind of trounced their cheaper value counterparts. But I mentioned, these stocks are expensive. And the question is, how expensive are they? So I'm going to show you the NASDAQ QQQ ETF. So it's a fund that you could buy that owns these stocks. And we show the top 10, or rather like the top 9 holdings here. And I think they all look familiar. I think everybody knows what every one of these companies do, except maybe number 7, which is NVIDIA. So I'm going to ask Shari, I'll put you on the spot. Do you know what NVIDIA does?
Well, I actually did my homework, so I do, but if I didn't, I would think it's some kind of spa treatment or something, but actually it's some kind of chip for gaming, I guess.
Yeah, that's it. That's exactly what they do. They make chips, and they're selling a lot of those chips today. So these are all really expensive stocks, and normally we don't get into valuation metrics like price earnings ratios, but we're going to do it today. And a price to earnings ratio means that when you buy a stock, you're entitled to your proportionate share of the company's earnings, because after all, you're now an owner of the company. So you get their share, you get your proportionate share of the profits. And the average price that you pay for each dollar that the company's earned over the last 12 months is about $35. So you're paying $35 for the privilege of owning your share of $1 of their profits. So that's pretty darn expensive, and it's actually very expensive relative to history. So usually these kind of stocks, these big growth stocks, are about 20% more expensive than the market as a whole. And today they're about 50% more expensive than the market. So there's this huge gap between how expensive growth stocks are versus those cheap value stocks. And we saw a similar gap during the dot-com bubble 20 years ago. The difference is, these are real companies. These are great companies. They're not like pets.com or other internet stocks that later went bankrupt. But at some point, their growth may slow down, and these stocks may not dominate the markets like the way they're doing today. And guess who agrees with us? Vanguard. So we look quite a bit at Vanguard's projections, and Vanguard looks out over 10 years periods, and these are their most recent projections for returns for US value stocks and growth stocks over the next 10 years. And you could see that value stocks, the return might be 6% or so. Not all that great, but significantly higher than growth stocks, which maybe like 2.5% returns. And it's not that these big tech companies are going to run into business trouble. It's just that their current prices already reflect tremendous growth. You're paying up big time in advance today for their future growth. So the bottom line is, we can't tell you when, but it's likely that at some point, cheaper stocks will do better than more expensive stocks. And that's why we like very much our diversified strategies that track the markets pretty closely, but give a little bit more weight to value stocks and a little less weight to growth stocks.
Great, thanks, Dave. And we've had, fortunately, a lot of potential clients coming to see us, and when we go under the hood and look at their portfolios, a lot of them do own these stocks, and they have grown quite a bit, and their investment plans are a little out of whack because they end up having a lot of exposure to these stocks. So we work with clients on that. So if you do own these stocks, take a step back, see what percentage these growth type stocks are in your portfolio. So we've talked about value growth, Dave. What about international? International has not been very popular. The popular kids have been US stocks. So can you explain why investors should still own international?
Yeah. So, the short answer is diversification. So there are periods where US stocks have done better, like recently, and there are periods where international stocks have done better. And by combining the two, you get a smoother ride. So let me just share a couple numbers with you again. Here we take a look at just how much the US has led by. So this is the last 10 years, and it looks at how the S&P 500 is done versus two international indexes, the MSCI World X USA Index, which tracks international markets of developed economies. So that's primarily the UK, continental Europe, Canada, Australia, Japan, countries like that. And then below that, the emerging markets index, which is really dominated by developing countries like China and like India. So you can see the last 10 years, boy, the USA has done a lot better. But not too long ago, we had what we call the lost decade, and that was the 10 years starting January 2000. And that was the 10 years that began with the dot-com bubble collapsing. And the annualized returns for the S&P 500 for big US companies was negative, maybe 1%. And that's annualized, not cumulative. And you could see here that the returns for non-US stocks, international and emerging markets, were positive for the period. So it matters where we're starting from. We know that US stocks are expensive relative to non-US stocks. And if you're expensive to begin with, that lowers your expected returns in the future. And again, guess who agrees with us, or maybe we agree with them, and that's Vanguard. So here we're showing Vanguard's 10-year projected returns for US stocks relative to international stocks. And you could see their 10-year projections show higher expected returns outside the US, primarily due to just much lower valuations. So that doesn't mean we're selling US stocks and buying international. And as a matter of fact, of every dollar that we put into stocks, we generally have about maybe 70 cents in the US and 30 cents outside the US. And we think that's a smart diversification. But that also leads to kind of the last question that was on the list while we're talking about expected returns, and that's what can investors expect going forward. So here we have Vanguard's projected returns for US stocks, for non-US stocks, and for bonds. And rather than get so precise about where we think returns are going to be, I think the big thing to take away is that returns very well might be much lower going forward than they've been in the past. We really do think bond returns will be lower, and that's just because we're simply starting out at such a low level of interest rates today. And the other thing that I'd mention is, Vanguard's showing kind of a range, but you probably would want to put even a bigger range around that. So I think investors do need to be prepared for lower returns from both stocks and bonds going forward. And I know, Shari, that you have some thoughts on how investors should prepare for lower returns going forward.
Yes, and part of our planning tools is we do full financial plans. And as Dave showed in the very beginning, history, the market was up, the S&P was up over 10%. Now we're looking at maybe 4 to 7. So we use these returns when we do projections. And every once in a while, I call it the Austin Powers. Someone will come see us and say, I've got $1 million. I need to spend 100,000. I can earn 10%. And we kind of have to go, well, you're forgetting about taxes and inflation. And that's why planning is so important. And, we get these calls all the time with the market volatility. What do we do? What do we do? And our firm was founded on 4 core principles. The first is that you need a plan. You need to have an asset allocation. The second is that you need to be diversified. And I think Dave talked a lot about that. The third is that you really need to be disciplined. So matter up markets, down markets, stay disciplined. Actually, there's 5. Taxes and costs matter. And the passive market tracking approach does that. And the last one is really when our firm in 2005, people kind of shook their head. We weren't the popular kids, now we are, because we advocate this value-added indexing approach, which is market tracking indexed approach for our clients. So that's it on the investments. I just want to touch really quickly because it's hard to believe that Thanksgiving is next week. And we are very busy with year-end planning with our clients. The good news is if you want to take notes, you want to take a little away, that's fine. But we are going to send you this list as part of our thank you in the next day or two. So Dave, if you could just bring up this year-end planning. And there is no silver bullet on this. Every client is different. And we know we have some accountants on this call. So I would recommend that you talk to your accountant to look at your individual situation. But just very quickly, a few things that you can do before year end. First of all, make sure that you've contributed the most that you can to your 401k, hopefully taking advantage of the match. If you have an I or individual 401k, make sure you make your contribution before year end. With the CARES Act, it says required minimum distributions or RMDs, but when you're 72 and a half, you have to take a portion or distribution from your IRA. This year, you no longer have to take it because of the CARES Act. So we're not saying you should or you shouldn't, it depends on your tax situation. It's very rare in our industry that we accelerate income, but we have seen some circumstances change financially for clients. So it may be a time to take your required minimum distribution, even though you don't have to, or something called a Roth conversion, where you take money from your IRA that's tax deferred, put it in a Roth that grows tax free, and you pay income on it. But you might be able to transfer a little bit under a low tax bracket. These are questions for your accountant. On your taxable accounts, if you know you're going to need the money, it might be time to take capital gains. If you've been sitting with some of those tech companies that Dave talked about and your exposure is getting a little high, we're not fortune tellers, but we don't think that tax rates are going to go lower. They possibly could go higher. So capital gain rates, if they're long-term, are pretty favorable. There is a lot of planning with charitable contributions. It used to be everyone was writing checks the last week of the year. But with the new tax law, which is actually a couple years old, a lot of clients of ours, and you might find that you're not itemizing anymore because you're not getting the full deductions for your real estate taxes or state and local taxes. So there's a lot of strategies that we work with our clients, and I could spend the whole 40 minutes on this, but I just want to highlight a few that you can, again, talk with us or your accountant on. And that's a donor advised fund where you pre-put money in 1 year and you can make donations over subsequent years. Bunching contributions, maybe you made a large pledge to a charity. Instead of paying it over 2 or 3 years and not realizing the deduction, you can pay that all off in 1 year and hopefully realize a deduction. If you're over 70 and a half, you can make a charitable contribution directly from your IRA up to 100,000. And again, if you have those growth stocks or even our index funds, everything is up right now. So you probably have appreciated stocks, so you can use that. If you're planning on doing appreciated stock, I would recommend you do it soon because a lot of the custodians have cutoffs of when you can send that in. 529s, you can contribute 10,000 per person and get a state deduction. So you might want to do that before year end, but make sure you tell your accountant because the 529 plans don't always send documentation for your taxes. And once a year, it's always a great time. This is enrollment time to look at your benefits, your health insurance, look at your deductibles, look at HSA. Make sure you're not missing any key benefits from your employer. So that's really what we had today, and we would welcome some questions you might have about either planning or any financial planning questions or investment questions. And let's see if we can stump Dave today. So please forward your questions. If you don't, I've got a few here that we have received. So again, in the Q&A, if there's any questions you have. Dave, I think you did such a great job that people don't really have any questions. You can put the planning down. So let's see where we're at here. Well, we said we'd be done at a certain time. I'm going to just ask Dave a couple questions that we get all the time. I just received a large bonus. Should I put it all in my investment strategy now, or what would you recommend?
Yeah, so I think the best approach is basically say, let's take that bonus, and instead of putting it all in the markets today or tomorrow or something like that, spread it out over a period of time. And I think for most of our clients, we look to do that strategy. We call it dollar cost averaging. And maybe we look to take that bonus and divide it into monthly increments and just put 1/12 in over the next 12 months, over the next year. And I think it gives you a little bit more confidence that you're not putting all that money in and perhaps a bad day, and maybe helps you sleep better at night. But it does have the effect of having you move forward and not be paralyzed and getting that money put to work.
Great. And we've got our question. Shall I donate from an IRA or from stocks? Does it make a difference? I am 70 and a half.
Yeah, so we'd have to look at your individual situation, but in many cases, it's very, very tax efficient to donate directly from your IRA. Having said that, I think we'd want to look at every client's individual situation, look at what kind of income bracket they're in, look at, perhaps what kind of gains there might be on a stock that they'd look to donate.
Great, thanks. And a real hot topic we hear on the news a lot is gold. What should investors be doing about gold, except for maybe buying some nice jewelry?
Yeah, that's my wife always says she wishes I would buy more gold, and people look at gold. It's kind of an interesting area of the investment markets. Gold itself doesn't have any intrinsic value other than its use for jewelry and things like that. But historically, people have looked at it as this kind of standard or storehouse of value, and they've looked at it as an inflation hedge. We look at the history of gold, and there are periods of time where gold does very well, and there are periods, long periods of time where gold really doesn't do much at all. And our thinking is that for the long run, your far better hedge against inflation is actually to own stocks, because companies' earnings grow along with the growth in the economy, and that growth typically will beat inflation over time. Historically, it's certainly done so. So we really don't think that gold has much of a place in a diversified economy. I know for some investors, it makes them comfortable knowing that they own maybe gold stocks or gold coins, but in the long run, I think you'll do better having that money invested in stocks.
Great. And maybe the last question, I actually received a call today with someone who was very nervous when the market was down, and now they're nervous that the market is back up. And they kind of were thinking, well, maybe I'll just get out, keep these gains, and then when the time is right, I'll get back in. Has that ever worked?
Yeah. So I wish that like someone could kind of ring a bell or something like that and say, the uncertainty's over, everything's safe now, get back into the market. Unfortunately, it doesn't happen. So to be successful with that strategy, you got to make two very, very smart decisions. You got to figure out now is a really good time to get out. And then perhaps you're right on that decision, and then stocks go down. And then you got to make the second decision. Now's a really good time to get back in. And the chances of getting both of those decisions right is really low. It's really, really difficult to time the markets. We say it again and again. You just have to have a long-term time horizon to be a stock investor. You just can't be so focused on what's the current economic environment like, what's the current political environment like. You have to think long term. That's 5 years out, 10 years out, even longer. So I think it's a difficult strategy. We wouldn't recommend it.
Great. And I'll take this next question because we received a question if we could explain a little more about the Roth IRA. So most of you probably understand when you invest in your 401k or an IRA, that money grows tax deferred. So you don't pay taxes every year. But what happens when you turn 72, there's a percentage that you need to take out. So I'm just going to use an example. You have $1 million IRA and your minimum distribution is 4%. That would be $40,000 that comes out. You have to pay taxes on that money that comes out. You can fund a Roth, but there is certain income limitations. So you could put money directly in a Roth. But what we see a lot of clients do is there's sometimes some gap years. So you retire at age 62, you don't need to take the money out till 72. So you have 10 years where you're not really having income coming in. So with that, we accelerate it. So we talk to our clients' accountants and we say, how much can we move from the IRA and putting it into the Roth? When you move from an IRA to a Roth, you pay taxes. So sometimes the accountant will say, well, you can move 50,000 at the 22% bracket. So we move that from the IRA to the Roth. Now that money will grow tax-free. You don't have to pay taxes on the earnings. You pay taxes when it moves from the IRA to the Roth, but not while it grows. So it's a very complicated formula. We work a lot with our clients starting about now to really get a handle on what their income projections will be for 2020 to see if it does make sense to convert an IRA to a Roth. So that kind of answers that question. Let me see if there's any other questions that we have. I think that's it, Dave. I guess you did such a good job. You've answered most of the questions. We want to thank you for coming. We have been trying to do webinars about twice a month, sometimes once a month throughout the year. Oh, we got another question. Oh, someone said good job. It wasn't a question, it was a comment. But we are probably going to take the month of December off. I'm sure you're all going to be busy. We're busy with our clients, but we will have some fun and entertaining webinars in January. We wish you all a very happy and healthy Thanksgiving and a happy and healthy new year, and may 2021 be a great year for all of us. So thank you for joining us. We will send our information. We are, as we always say, we're here to answer any questions, and we want to maximize your return on life. So thank you.